The only way is up, baby, for you. Oh, God, I hate that song. I don't know why some people like the 80s. I don't think much of the music was very good. Though I think when I was in those years, when I was only like, what, 12, it just seemed to be good. Choose 1985, most excellent album. But nowadays, it all just seems to be middle-aged women who like most of the 80s song, and I don't really want to hang around middle-aged women. Anyway, diagonal spreads, directional trading for people who suck at directional trading. Yep, that's me. I am a master of putting on a trade at the wrong time. I can look at a stock and go, yeah, that's going up. And just when I get out of the trade, it goes up. Yeah. So if you're that kind of person and you just, know the stock will eventually go up, this is a good little seminar for you. What we're going to do is go through the rundown, a recap, a list of things we shall discuss in the next half hour, or maybe 40 minutes. We'll see if we get to 40 minutes. The bit at the top, my brothers and sisters of the military will know very well. During this period of instruction, you will learn. And we've had that shouted to us many, many times. So I'm going to shout at you. During this period of instruction, you will learn. We are going to go through option trading recap with just how you can make money with options. And remember, this is diagonal. This is directional trading. This is not range-bound trading, directional, either up or down. So we're going to go through different ways we can make money doing that. And then we're going to go through when to go diagonal. We'll just have a look through some charts, and we'll probably use the sector ETFs for that, because that's a good little breakdown. We'll then go through what a diagonal spread is, which is pretty straightforward. It's a time spread, but it's a calendar spread with different dates and different strikes, but we'll do that. Very easy, especially if you know what a calendar spread is. My personal favorite about this is how to make money being wrong, or how to make money when you've got the timing wrong, or how to make money when you've picked the wrong strikes, or how to make money waiting to be right. Pick any one of those. We'll go through it. If you're a Pink Floyd fan, or a Pink Floyd fan, you have to know when to leave the show. We'll go through the options on when to get out, because you don't want to stay in it forever, and you don't want to try and milk all of the data or theta out of the trade. At the last bit will be some extra bits just from years and years and, oh my God, years of doing this particular trade. We'll go through some tidbits, and then we'll come back with a little summary. And if anyone has any questions, pop them up on Discord, and I will do another video with a Q&A session, or I may even just do a Q&A session on Discord, because we're that clever now. Right. The many ways to make money trading options. There's heaps of them. But for this little example, we're going to choose going long. We'll come back to shorting the market a bit later. Going long. So let's pick them. I've picked, 5 different ways you can come through. So I've got the out of the money call, the in the money call, the deep in the money call, the old-fashioned vertical spread, and the other ones where you put flies and calendars up in different places, and even split strikes. You can sort of make them directional. But let's start with the obvious one. To buy an out of the money call. This is what everyone does on Wall Street bets. And out of 1,000 people that do it, I'd say 100 people get it right. How do I do that? Because the delta of an out of the money call is a 10 delta, a 1 in 10. It is like you going to the horse racing, picking a 10-to-1 horse, throwing a couple of grand down and going, that one. If you're right, oh my God, you're right. You're so right. If you're wrong, it's all the bad bits of the Bible. So let's go through and have a quick chat. Shall we jump into toss? I think we should jump into toss. Let's have a look at Microsoft. We're going to use Microsoft today because it's just an easy chart to trade. And it's one of my favorites because of the way it sort of range bounds itself. I mean, look at the last year. It's glorious to trade. So Microsoft, $407 at the moment, down $2.88 today. Nice. Bit of resistance down here at sort of the 400 to 405 mark. I like Microsoft here, and we'll use this all day again because I think it's a good time to get to Microsoft. Shh, don't tell anyone. Let's look at the option chain, and let's say $420 is our target. We're going to get to $420. Groovy. $420 is this option. It's a call option. It's worth $1.88. There is a 21% chance we're going to get there, and I'm using the probability of in the money. There's a 20% chance this option is going to be in the money, and we're paying $1.88 for it. Beauty. Here's the mathematics side of it. If that option in the next 14 days gets in the money, i.e. if Microsoft gets to $420 in the next 14 days, that option will be worth 0. And you would have lost all your money because you paid $1.88 for it. The option is only at $420. It's not worth anything yet. The actual stock has to get to $421.88 for you to even break even. So let's say you want to double your money. You've got to get to 422.5. Close enough, isn't it? I think so. Probably not. It's a little bit under still. So let's say you want to double your money. You've got to get to the 422.5. There is a 17% chance of you doubling your money. That means I write 1 in 5 times, but I only double my money every time I write 1 in 5 times. This is called going broke. If anyone needs more explanation of the mathematics of that, hit me in Discord, but it's very straightforward for anyone who's done a bit of maths. You're right once every 5 times, but you only double your money once every 5 times, which means you're going backwards. So YOLO works only if you're right, and usually only if you're right that particular time. Try to ignore the out of the money call. Buying an in the money call. It's like stock, but you don't make any cash doing it. So let's go back here and pick, what are we at, 410-ish? 407.5, we can pick this one. So the in the money calls were $6.50. What's going to happen, for every dollar the stock goes up, you make 50 cents. That's how the delta works. You're a 50 delta, the stock goes up $1, you make 50 cents. Nothing wrong with that. Nice thing is that if it goes down, you lose 50 cents. Not a really good speculative way to do things. The only time you really want to do that is with a vertical spread, which we'll go through in a minute. So it's like stock. Time's left is an issue, but you just need the stock to move. You're not making as much money going up, not making as much money going down. You can run out of cash with theta burn. Not my favorite. If you're going to do an option purchase, this is what I would do. Buy a deep in the money call. Why? Because it behaves like stock. So let's pick like an 80 delta, which is let's pick a 390. Cost you $20, but it's going to behave like stock. The stock goes up $1, you make $1. The stock goes down, you don't actually lose as much on the way down. And I love this trade. I've done it so many times, it's not funny. Buy the 80 delta call if you want to be long the stock. I'd do that more than I'd use a zebra. I think the zebra trade's a little bit of a overrun thing, but we all can make our own decisions there. $20. You're buying and owning 100 shares of Microsoft for $20. Good stock replacement, brilliant stock replacement. Good thing if you want to do a poor man's covered call. 80 delta, self-styles against it. Voila. The vertical spread, my favorite vertical spread is buy 1 in the money, buy 1 out of the money. Let's do that. So we're going to buy vertical. Actually, that's the wrong way to do it, isn't it? Let's analyze a vertical. Buy 1 in the money, buy 1 out of the money. So in the money is the 4, let's do the 4, 5, 4, 10. Pay $2.68, it's $5 wide. Just easy way to make money. And put it forward 45 days, 30 days, 35 days. Great way to trade because you make money if it goes up. You lose a bit of money if it goes down, but you can manage it. And it's a good way to say, you know what, I think Microsoft's going up. Boom, vertical trade. Very nice. Other ways you can do it. We played a bit of these, and Amit's really good at doing this, where he throws a butterfly halfway up the trade. So what that would be is if I went here and I just said, give me a butterfly. Butterfly. There you go. If you look at that in the risk profile, you don't need to hit it exactly. Put it, I probably put this, 14th of March. Ooh, we're not trading there. 7th of March, it's not trading there. 28th, there we go. We are back at 28th. But yeah, all you're doing is sticking a butterfly up here. And it's a very cheap trade. 7 cents will make you 12 bucks. So $7 will make you $120. It's a very, very cheap trade. I'd probably make it a little bit wider. In fact, if I did this, I'd probably go 25, 20, 30. And now you're spending 38 cents to make $43. Not bad. Not bad at all. 38 cents, great return on investment, very low risk. We call them expected move butterflies. So you'd look into the simulated trades, you go, where's the 18 delta? All right, so $18 at 422.5, 420, 425. Beautiful. Throw it in there. Yep, absolutely perfect. $10, $5 wide, $5 wide, risking 38 cents. There is only a 10% chance it's going to come up, but you're only paying 38 cents for it. So it's a speculative trade. It's a very cheap shot. Time bomb butterflies, we call them, or expect to move butterflies, or that kind of ilk. So there's ways to get long. We use them all. I hate the out of the money call, but I'm going to teach you some new way to do it, which is the diagonal. So here we go. Remember that bit where I said, don't buy an out of the money call? Well, the first thing we're going to do is we're going to buy an out of the money call. Yeah, good. Okay. The reason we do the out of the money call is because we're bullish on the trade. And the logic is we buy the out of the money call, we sell a further away out of the money call as the hedge, and we try and make money on this hedge while we're waiting for the stock to go up. Now let's jump into TOS and let's break this down. There's your plan. Let's show you what it looks like, how it works, why we're doing it, and why we're so very, very clever. Let's pick our little chart of Microsoft again. We're at 407. We want the stock to hit 420. That's our game. 420 sometime in the next couple of weeks. Be wonderful. 420 is a number. Cool. Let's go into the analyze trade. And here I've built a trade. I am buying the 420 call and I'm selling the 422.5 against it. So I'm buying the 420 and I'm selling the one strike above it, but in a much closer time frame. Now, when you make this trade, I want you to do this to get it into your melon, how it works. 4th of April, 420. 4th of April, 420, buy. $7.85. 422.50 call on 28th of Feb, sell. So we bought an option for $7.85. Let's call it $8 because it's easier. We've sold a call for $1.40, $1.50. Cool, no problem at all. The advantage of this is that we get the stupid profits from the out of the money call if the stock does move, but if we're waiting for it, we get to collect the theta on the nearer side option. Let me go through that again. The 420 call, we're waiting to go in the money. While it's happening, we're selling the 422 against it and collecting the $1.40. So that option there, $7.80 or $7.85 it is now. If I get to collect most of that $1.40, let's say I get $1 back in the penultimate week, then all of a sudden that call option I only paid $6.85 for. Do it the next week, ooh, $5.85. Do it the next week, $4.85. So you're collecting money and you're lowering the cost of the initial option. You'll see where I'm going with this? Excellent. Now, what's that $1.40 option going to be worth? Well, that's easy. 28th of Feb, 422.50, worth $1.36, $1.40 at the moment. Now let's just look at what the 422.50 is worth in 7 days. 33 cents. Collected $1. You beauty. The stock doesn't move, you've collected $1. If the stock moves a little bit, you've probably collected 80 cents. If the stock doesn't move at all, you may even collect a little bit more. The point is you've got that original option and you're lowering the cost basis of the original. Life's good. While you're waiting, you're making money. Let's look at the risk profile. We're somewhere near here. 410. Don't think we're that high yet, are we? 407. So let's say we're back here somewhere. If we do get to 420, you've spent $6.30 on this trade. And let's say we get to it in a week's time. You've made 270 bucks. If you get to it on the 30th, that's a bit too close. What's going on there? Before the end of March, you've made $360. You've made 50% on the trade, or 50% on your yield and the cost of the trade by putting a diagonal trade on. And if you're wrong, you just keep lowering the cost basis. So now the option's worth less. So let's say we get 7 days into the future. You simply go back into here. You sell this. My apologies. You buy the 28th of Feb back. And then you sell the 7th of March against it. And you just find the 422.50. If the stock goes down a bit, you can sell the 420 and turn it into a calendar. Makes no difference. You just don't really want to go below 420 unless the stock really tanks. I've had some examples of that with American Express lately where I've sold the 417 or the 415 against it because we've been absolutely caned. And I'm just trying to get my $7.85 back so I can get out with my shirt. But the whole process of this is we just keep rolling. So, long out of the money call. You don't want to go too far away because it makes the out of the money call too expensive. Sell the further out of the money as the hedge, 1 to 2 strikes. It could be the 420, the 422.5, the 425, the 427 if you really want to be bold, but you won't get much premium back. And you roll the call every 7 to 8 days. Now, basically, you are taking the second last week or the penultimate week of theta out of the call option while waiting for the move up. That's the trade. Now, before you guys all get clever and go, oh, but what happens if I just get the last week and I can just, no. The second last week of theta, you make more money. Think of that option. You only had 33 cents left in the last week. Don't sell a 33-cent option. Keep selling the $1.40, the $1.40, the $1.50, the $1.40. Just keep selling that, collecting your dollar, move on, make money, and experience the wonderful of a yield. $600 trade, making you 200 to 300 bucks. There can't be much wrong with that. Let us move on. Which options do I buy and sell? So this is the big question everyone asks, and it's based on technical analysis. So let's go back to TOS and let's have a look at Fangman. If we go to charts, flexible grid, and let's pick Fangman. Make it a bit bigger. Fangman plus T. Microsoft, Apple, Nvidia, Google, Meta / Facebook, Amazon, Netflix, and Tesla. Have a look at these charts, and at any one of these charts with a bit of technical knowledge, you can work out what to do. Microsoft, lots of resistance here. We're going long Microsoft. Apple, middle of the range, looks like it's pushing up. It's in an uptrend. Wait for it to pull back. Going back up. Nvidia, Jesus. Nvidia is a bit harder. It moves around like a, I can't use that phrase. It moves around a lot. So I think Nvidia is more of an advanced move type thing. And the same with Google. The problem with Google is it gaps everywhere. If you're right, woohoo, you're right. Google at the moment is coming down to the gap. I'd probably go long Google here, 180 to the 190. Meta, yeah, good luck trying to trade that. I mean, you would have made a fortune because it made it up really quickly, but timing, that's a bit difficult. Same type of thing. It's in an uptrend. You want to pull back to sort of the 650 mark before you went long on that. Amazon, pretty easy thing to trade. It's only a $230 stock, but same thing. It's middle of the range here. You might get to pull back to somewhere around 218, 220 to go long. Netflix, yeah, if you may as well go outside and just burn your money. Tesla, you may as well go outside and burn the money you lost on Netflix and Tesla. And no, I'd avoid those two because same thing. They're too hard to trade. You can make money, but you have to be right. And the whole idea of this is I don't want to be right. I'd rather just make $2 in Microsoft because it's the same $2 I'll make in Netflix. So let's pick Google. All right? And let's work out how we're going to try and pick the options in a Google trade. And I'm doing this completely off the cuff. Here is the Google chart. What do we got here? We have a bit of price support here and a bit of price support here. So we're at 185 at the moment. We'd like it to move up to 200. That's one way to do it. The other way we could do it is to get rid of you, put a fib on there. Yeah, one of these is price retracement. That's extensions. There you are. And say we're going to get up to the 196 level. Then we buy the 195, sell the 197. To be honest, with this kind of thing, you can just get creative. So let's take Google as an example here. We think we're going to get back up to 195. So all you would do is go to add some sim trades on this. Let's pick the 51. Double dragon on Google, Jesus. Pick the 51, wait for the data to come down, bingo. So if we go into here, let's have a look at out the money. We are looking at the chart, we said 195. Okay, 195 call, $3.95. It's a 36 delta. Yeah, so somewhere around $4. And against that, 14 days out, we're going to sell one strike out of the money. So what's that? 195 with 197. We're going to get 68 cents for it. It's probably not enough money. We may have to go back one. So pick the 190 call, pay $6.20 for it, and then sell the 192.50 for it. The chart profile looks like that. I'll move the dates back to something close to today. Not bad. So you pay $6.20, collecting $1.50. You'll burn $1 out of it as it moves up. You can sort of see the process. We're trying to burn $1 each week while waiting to be right. And a 190 calls on a bad move. The chart looks nice. There you go. So to answer how do you pick your strikes, you look at your chart, you pick your target, and then build it around your target. That's about it. You can use technical analysis. You can even use delta. I mean, if we did the same thing and looked at the analyzed trade, I'd probably buy the 30 delta, even the 40 delta, somewhere between a 30 and 40 delta, and then sell the 30 to 35 delta against it, because there's a 60% chance of it touching. So pick your strikes using your technical analysis, your statistics, your option analysis, whatever you want. The main thing is that you don't want to be buying an $8 option and selling a 50-cent call against it, because you're just going to get killed. You want to be selling something like a $6, $7, $8, but you want to be selling at least $1.50 against something. Use that as your guideline. Now, let's recap what we're doing here, because this is the part that everyone seems to want to start reorganizing. But if I did this, and if I did this, and I did this. We are long and out of the money call option. We are YOLOing. YOLOing? Yeah, YOLOing. YOLOing? YOLO, it doesn't matter. We are long and out of the money call option. But to account for that, and we're waiting for the stock to move, we are selling a further out of the money call option to hedge the position. We need the stock to move to make money because we are directional, but we're collecting some of the theta while we're waiting. And it's great for things where you know Microsoft should go up from here. I just don't know when it's going to happen. So while I'm waiting, I'll collect a buck, collect a buck, collect a buck. Do it enough, and you'll end up with a free call option and zero risk. Because imagine it, $1.50. Let's say you get $1.20, $1.20, $1.20, $1.20. Your call option's only worth $2 by then. And you can keep going if you go long enough, and you'll end up with an option that's worth nothing, and it's just pure profit. Those are the days. It's only happened twice to me, but I'll take it. Just keep rolling that short. Keep rolling, keep rolling, keep rolling. I'll come back to the long portfolio in a minute. Let's move on. So the next part of this will have to be, what's the downside? Because all I've told you so far is the good stuff. If the stock moves up to your out of the money call option straight away, so let's say Microsoft tomorrow goes to 420, or 2 days time goes to 420, you won't make as much money. That's the downside. It's still a pretty good winning trade, but your yield will be like 15, 20%, not 30 or 40%. This is the trade-off. I mean, that's the trade-off of a hedge. You don't want to be long and out of the money call because you're spending a lot of money. And we want to have the opportunity to make some money for the 90% of the time. It never goes there tomorrow. So in my 21 years of trading, which actually is 22 years now, it's just a better option because you don't have to be right on both direction and timing. And the longer you're around this whole industry, the more you realize that it's just too hard being right all the time. And I don't want to make a living having to be right. I'd rather make a living hedging my bets a bit way, hedging those bets both ways and making some cash here and there. That's your downside. Now, for those of you out there that have a 401k or personal share portfolio or alongside the portfolio, I have a rather large long portfolio, which I claim most of my living off, and I'm long lots of stock. We do a thing called the wheel trade, which is where I own the stock to collect the dividends and I own the stock to collect premium against it. I do this. And all I'm doing is just selling out of the money calls against my long stock. And I collect weekly dividends. I sell something that's 2 weeks away, I roll it with 7 days to go. 2 weeks away, roll it with 7 days to go. What that would look like is this. So for you guys, because you're a little luckier, if I had, let's go back to Microsoft, clear this off. It's what we call the covered call. As you can see here, we're long 100 shares of Microsoft, which is 100 delta. Now against that, I'm going to go 14 days out and I'm going to sell the, let's say the 20 delta. 25 delta. 25 delta? No, I think we'll go 20 delta. So for every 100 shares, you sell one option and you collect $1.85 on your 407. Now, I don't know if Microsoft pays a dividend, but I'll happily take $1 of dividend every week out of Microsoft. And all you do is just roll it. Next week, roll it. Next week, roll it. And you just keep doing the 20 delta. Just keep going, just keep going. This is how I make most of my income trading. I'll have, 10,000 shares of Microsoft or 1,000 shares of Microsoft, and I'll sell 10 contracts against it. And to show you what that looks like, 1,000 shares, put a risk profile up, you collect good money on it. You really do. I mean, it's $1.85, 10 of those is $1,000. You're looking at $1,000 a month against your Microsoft holding. And otherwise, you're just leaving Microsoft there to go 407, 410, 402, 425, 415, and just bouncing around. You're not really collecting that money because it's just the stock going up. the way you collect income against it is you sell options against it. Take a buck, take a buck, take a buck. 10 options, $1,000. $1,000 every week just from your Microsoft holding. It's a wonderful way to do it. And I mean, you do the diagonal with a good yield on a $600 account. But if you've got long stock, the covered call is by far the greatest way to collect a dividend weekly. Now that we know everything about our long portfolio, we've got everything covered. Here's a little outside the box thinking. Anything you can do with calls, you can do with puts. So let's say you're looking at a stock and you're thinking that's just ridiculous, it can't go any higher than this, or something's at the top of its range. You can do exactly the same thing with puts by being short. Let's go back to TOS. Here we have Fangman plus T, and it's pretty easy to look in here and see which ones you're going to short. No, 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 yes. No, yes. Widowmaker, Widowmaker. Let's take on Meta. Should we take on Meta? Look at that stupid move. Charts, Meta, there we go. So we're at 738 at the moment. Yeah, we've had 4 down days in about 2 months. So let's go somewhere around 710. 710? I like 710. Analyze, Meta. Let's grab the 710 put. We're going to pay $18.40 for it. 710 put, yep. And then we're going to sell the 705 against it. Now this time we're going below because we're putting. We want to sell one more out of the money. Same dates, 28th of Feb, 4th of April. Looks a little bit like every other chart except in reverse. Now, yes, we're collecting more money, $4.40, but we're also paying a lot more for it. We're paying $18. So it's a more expensive trade for the down moves because of that wonderful thing called skew. And all skew is, puts are more expensive than calls. You look up skew anywhere on one of the Google things, I'll give you a better example. But basically, puts are always more expensive than calls, but you do get to collect more. So the whole idea here is those $18 puts that you bought won't go down as much because of the stupid volatility, but you are making, let's say, $4.40. What is the 7-day? What are we looking at? 705 put, $1.59. So you're collecting $3 a week or $300 a week instead of $100 a week. Yes, the yield is pretty good because those puts stay up, collect more money, but you've got to find the stocks to go down, and you really, 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 really need the stock to go down while you're waiting for it to happen because they don't decay as quickly. You find them sort of decaying quite brutally in the last couple of days before the weekend. So just keep in mind that what you do with calls, you can do with puts. Right. You put the trade on, trade's gone well, a couple of weeks later, when do you close it? The obvious one is when the stock hits your target. Now, that's not always the best way to do it because your target isn't the call option. If we go back to our trade here in Microsoft, if Anthony can type today, and we look at our chart we had here, where we analyze risk profile. Now let's just go to chart. All right, Microsoft. 407, let's say the stock gets to 420. All you do is you sell the 425 against it. If it gets to 425, you sell the 430 against it, or you sell the 435 against it. Because remember, that underlying call is now stock. Just think of it. As soon as an option becomes in the money, it becomes stock. So you still got this call at 420, 425, 430, 435, and you just keep selling calls against it. And you keep going until you run out of, you ready for this? Time. So you've sold the 14, then you sold the 21, and you sold the 14th of March, and then when you sold the 21st of March, then with 2 weeks to go, I probably would get out of the trade because the amount of theta you're collecting gets less and less the closer you get to it. Because remember, the long is going to decay just as much as the short. So 2 weeks to go, get out. And if you still think it's going to go up, just move everything forward and buy the same option, except this time go and get a 50-day option and sell the 14 against it again. Nothing's stopping you recycling the trade, but just get out of this one. It's done. When there's no money left in the short, what you're going to find is if we go to, say, the 7-day, and you've got something that is like the 422.5, there's 33 cents in it. When you've only got 14 days to go, there's no point trying to sell 33 cents. Don't do it. If it gets to a point where there's no money left in the short for you to sell, get out of the trade or put another trade on. Pretty straightforward. The bit that we don't like, it's the part where you're so wrong, even your mother, wife, significant other can't stand you bitching and moaning about how the stock moved against you. So let's say we're in Microsoft, and Microsoft goes to 385 and still keeps moving down. You sold the 410, you sold the 405, you sold the 400. You've done all this trying to roll down to collect just a bit to get against that stock you had before, but it still keeps going down. Get out of the trade. You're wrong. The whole original part of the trade was we were going to bounce somewhere around the 400 mark. You go below 400, I mean, look, resistance, 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 resistance. All this is resistance. And you're falling through it. Get out of the trade. You're wrong. Take your loss. Carry on. Now, after you have got out and you close this one, nothing is stopping you from putting another one straight on, because even a blind squirrel will trip over a nut every now and then. It's a great saying, that. I love it. So let's say we go down to 385. Once you're at 385, put another one on and make it the 395, sell the 397.5. Nothing's stopping you putting another one on. Just get out of the one you're in, because you won't make any money on it when you've got a 420 call up here that's worth nothing and you're selling a 395 against it. Realize when you're wrong. Wait for everything to come back into your nice circle again, where it's all back in your favor, or at least you think it's back in your favor, and then you just put the trade back on. All right, so when it hits your target, when there's no more money to be made on the short, when you're really, really wrong, and don't forget you can always put another one on once it comes back in. And there's lots of stocks out there. It doesn't have to keep going with this one trade. It's, don't name your stock because you're going to eat it. Which stocks do you use for this? I love this question because it took me a long time to figure it out too. Number one, blue chips. Just pick the blue chip stocks. $2 you make in Intel is just the same as the $2 you make in Nvidia. The $1.10 you make in XLE is exactly the same as the $1.10 you made in Tesla. It don't make no never mind. Just find something that's lovely and cyclical. I have these particular grids. This is Fangman plus T. I like Fangman when it hits my sort of things. Like, for example, if you look at Apple, Apple gets down to 220. It's time to get onto that long move again. The same for Nvidia. I'll probably get in about 110. There seems to be a bit of resistance there. If this gap ever fills, I'd probably get back into Google. I don't mind here, but if it falls, you're getting in at 165, and a $20 drop's a big drop. Meta, yeah. Amazon, probably back down to the 220 mark. Netflix, I don't touch. And Tesla, I don't like burning money. I'm going to keep my money. We're not trading Tesla. The other ones we have are the US sectors, which are all your ETFs. So, I mean, look at XLK, great trade. I'd rather trade that half the time than others, because resistance, 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 and resistance at the top. You go short at 240, you go long at 225. And that's almost a year's worth. XLV, which is healthcare, a little bit harder because it's biotech. It doesn't really range well, but it does move well against its fibs. So XLV is not a bad one. XLP is a great trade because it trends. XLF financials have done it for years. I'm actually short XLF at the moment. I've got put options against XLF to fall back down. XLE, the weird thing with XLE, it used to be boring, and now it's a biotech. It moves so much all the time. It's a very cheap stock, but it just moves a lot. And I can't quite figure out how. So I've left XLE alone. XLU doesn't move enough to make any money. XLI, same thing. I just don't find it moves. And XRT, you don't get any premium. So just pick stocks that trend or trade. I mean, Fangman is really easy to do, especially with Microsoft Apple. And try and pick 1, 2, 3, 4 that you get the swing of, you get the idea of, and you sort of get a feeling for how it's going to move. So avoid Fangman unless you have a death wish, which is true. Apple, Microsoft, Amazon are the less volatile ones. They trend and trade and stay in a box a lot nicer. FPIU, etc. you can trade. I quite like those ones. But try and pick boring stocks. I mean, even things like IBM, Hewlett Packard, Cisco, though I don't think you'll collect much premium on Cisco, but just pick boring stocks. Remember, you're looking to try and get $1 a week. So go through your grids and try and figure out that if I spend $6 on a stock, I want to collect $1 every week. Use that as your game plan and you'll be fine. And as I said here, money made in XLU is the same color, weight and size as money made in NVIDIA. Don't get stuck in one particular setup. Right, some bonus tips. Here we go. Listen up, kids. This is the important stuff, because this is where everyone goes, here's a wonderful trading plan. I'm sure I can make this better. You. Avoid speculation. We're traders, not speculators. Now, what's the difference? Speculators are looking to make 50% or 100% or 200% or 300%. And it's the people where you sit there and go, yeah, I reckon. Well, I'm Australian, so we say I reckon. You guys, well, are not Australian, so you may use a different word. But it's the part where you have absolutely no basis of any idea whatsoever other than your guts going, oh, I reckon it's going up. Avoid that. You just do the maths. I'm collecting $6 on a trade. I want to sell $1 against it. Makes sense. Go ahead. One's trading. I think that's going to be $4.25 in 2 weeks. I'm going to pull on that one. Isn't trading. Look at the chart. Try and work out if the numbers make sense. Buy a $6 or $7 option. Sell $1.50 against it. Collect your money. Get it to make sense in your head. Get it to make sense with the math. Then put the trade on. 20-25% per annum is reasonable. Yes, it is. I've done that pretty much every year on this for over a decade. No problem at all. I've had some years of 40, I've had some years of 20, I've had some years of 35, I've had some years of 60. Yeah, I had a 60. That was a good one. I think it was a Trump year, actually. 2017. It was 2017. Everything just went up. So good. Keep in mind that the short option, the one you're selling, it's meant to lose money. Don't get lost in the short option. Oh, I'm losing money on the short option. Oh, damn. No, quick, I got to save it. I need the stock to go down. No. You want the stock going up. You want to blow through that short option like it's not even there. It is the egg you broke to make the omelet. Just let the short option die. If it goes nowhere, you can just sell another one. Sell another one, sell another one. Don't hold the short to expiration. That goes without saying. Don't hold it. It's just a rookie error. Don't hold the short expiration. Just get the last week of expiration. There's just not enough money there. You want the second last week. Collect $1 in the second last week. Collect 30 cents in the last week. Which one do you want to keep? Don't hold expiration. Roll it. Earnings. Forgot about this. If someone has earnings and you get a good earnings report, but the stock goes down. I mean, the best example of this was Microsoft this year in the last earnings one. Let me go back into charts. See this? This is the earnings drop. They came out and said, everything's fine, everything's good. We just don't think we're going to make as much money going forward. Microsoft's going to make money going forward because they're the second largest company on the planet. All you have to do is just put it on at the bottom, which is what I'm doing here. And I've had it on for ages. I made money on the move up here. I think it sort of sat around here and was stagnant, and I'm about to put another one on now. If earnings come out with good earnings and the stock drops, boom, whack it on. Here's a good example. Earnings fell. Let's find another earnings call. Earnings fell. It happens all the time. Earnings fell, bounces back up again. Post earnings, this is a great trade. And I think that's about us done, kids. So let's go back and see if we covered everything. Option trading, how to trade? Yeah, we covered that. We worked out the difference of which particular ones we wanted to play with. When to go diagonal, we covered that. The diagonal spread, what it was. It's a calendar spread with different strikes. How to make money being wrong, we covered that. And when to leave the show, some extra bits and a little summary at the end. There you go, ladies and gentlemen. There is your diagonal trade. During this period of instruction, you did learn all that. I wish you all the very best. Any questions, please post it in the Discord. I will be there quite a bit over the next couple of weeks, and I'm happy to answer any questions, even happy to put another session together if you want some more information. As I said, this is pretty much how I trade. I'd say 70 to 75% of my portfolio is this particular method. And it's done well by me for a long time in many different kinds of markets. Catch you all in the next one.